Good morning. Hope you guys are having a great day. Today we're going to talk about stocks. And after we talk about stocks for the notes today, we will be going on and starting our Investopedia unit. So that way you guys can start buying and selling stocks through our simulation. So stocks. What is a stock? A stock is just a part of an ownership of a company. It's just one small part that somebody might own, and a person that actually owns that stock is called a stockholder. I know it's pretty simple and it's going to be easy to remember. So a stock is actually the share of that particular company, and a stockholder is the person that owns that part of the company. Stocks are a medium risk and return investment. It's a little bit more riskier than a bond, which is a very low risk and low return investment, and a stock is just a step above that. It's very easy to figure out the ownership percentage, and what that is just the amount of, or the percentage of the amount a person owns in the company. So for example, as you see on the screen, if somebody owns 1,000 shares of a particular company and there are 10,000 shares that are outstanding or available, then you are going to be owning 10% of that particular company. A stock certificate is something that used to happen. You actually used to get a piece of paper with the company's name on it, and it would tell you how many pieces of stock that you owned in that company, what the stock was, whether it be preferred or if it is a common stock, and along with that, it would also have your name and some personal information on there. However, nowadays, with everything being electronic, everything is done and kept over the internet and through the company's online system. Common stock is what most people own, and common stock represents the type of stock where you don't necessarily get a dividend or a profit at any certain time. If a company is doing very well, you are going to get a dividend, and if a company is not doing very well, you won't get anything at all. With common stock, good morning, class. Hope you guys are having a great day. So today we're going to talk a little bit about stocks. Stocks are just a certain percentage or certain share in a company that you would own. And if you actually hold that particular stock in a company, you are known as a stockholder. And when you are a stockholder, you actually own part of that company that you have or hold stock in. Stocks are known as more of a medium risk and medium return investment. It's a little bit more risky than bonds, which has a very strict what you are going to get, how much you are paying at the very end, and you'll get a certain percentage back no matter what. However, with stocks, there's not necessarily a guarantee that you will get anything out of it, especially if the stock isn't doing well as you go along. Ownership of a stock is very easy to calculate, the percentage. And what you would do is you take the shares that you would own, so for example, maybe 1,000 shares, and the shares that are outstanding for the company, which, for example, 10,000 shares. You would divide those two out. So you would take 1,000 shares divided by 10,000 shares, and that gives you 10% ownership of that particular company. A stock certificate is something that you would get kind of in the older days. You actually receive a paper stock certificate. It would say the name of the company. It would have some personal information about you on it, along with the number of shares that you would own in that particular company. However, nowadays everything is electronically, so everything's tracked through the actual company that you own stock in, or through whatever company that you are buying the stock through. There's two different types of stock. The first one is common stock. Common stock is the stock that pays a dividend that is not necessarily always high or low. It's variable. It changes all the time depending on what is going on in the market. However, because of that, people that own common stock typically have voting rights to go along with that. So if a company wants to make a major policy change, they may, or they would have to let the stockholders know, and they would have to call a vote or a shareholders meeting, so that way you were able to come and actually vote on the major policy change that they would want to have. For example, if you should all know that the Packers are a publicly traded company, you can actually buy stock in the Green Bay Packers. If you own stock, they do have a stockholders meeting once a year in which you are able to go to the Packers Stadium, and they typically give you a tour. You get to go out onto the fields. Sometimes they have some Packers there ready for you to meet. And then you are able to vote on the major policy changes that they might have throughout the year. So, for example, the Green Bay Packers have a new tailgating thing. I don't know what you would want to call it. Not really into football that much. However, that was voted on by the stockholders as something that they would pass, and so it would now be put into effect whenever they are able to get that up and running. Preferred stock is one that it's less risky. Stock is risky no matter what. However, if you actually own preferred stock, you are guaranteed to have a certain dividend paid to you no matter what. However, the flip side with that, they don't have any voting rights. So you get a certain dollar amount no matter what, or dividend every single time they pay out dividends, whether the company is doing poorly or if they're doing really well. However, because of that, they're not going to give you any voting rights because you're not taking any of that risk. However, again, you get a certain percentage no matter what. So that is a definite good thing. However, you also have to think about the fact that it may be less risky and you do get this certain percentage, but yes, it's nice if the company is doing not so well in the stock market, or it's not making so many profits and you're guaranteed that amount of money. However, if a company is doing really, really well, you still don't get as much money as somebody with common stock because of the fact that they have more risk and it's a variable that they're getting paid, whereas you have a fixed amount. So you got to take your trade-offs. Do you want to take more risk and possibly get more reward and get more payments in the form of dividends? Or do you want to be guaranteed a certain payment no matter what? There are many different types of stock that we will be going over during the course of this unit. However, it's more beneficial to talk about them as we go along. So you have income stocks, and those are stocks that have a consistent history of paying high dividends. So your dividends, remember, is your profits that they're sharing with the people that are shareholders or stockholders. Now, for an example like this would be a bigger company like Google. They have a really big track record of actually paying out profits to their stockholders. Same thing with Apple. We Energies is another big company that are also income stocks. There are many different factors that go along with setting prices for stocks. However, there's three major ones that we will be discussing. So you have to think about the company. So when a company is performing well, obviously that stock is something that you want to buy. You want to get invested in it, and you want to make sure that you are trying to get some of that profit. However, on the flip side, if it starts to go down, that means that that company is not as attractive, and people will try to sell that to get out of it so that they won't lose as much money. We talked about interest rates already the last class period, and we have to also look at the market too. As time goes on, the stock market fluctuates just like the stocks themselves. So you may hear, if your parents kind of talk about financial things with you, or you might just overhear a conversation, they might say that the stock market is down today. And that just means that most of the prices are down and the stocks are down, so the market overall is down and it's not making a lot of money out there. You have to remember that stocks aren't there for a short-term gain. You're putting your money in stocks for the long term. That's not to say that you can't take out your money right away if you put it in. However, you're trying to think more long term with stocks. That's where you're going to see the most profit. Let's talk about risk. Risk is a huge thing when we talk about investing your money, and it doesn't matter what we're talking about. The only one that really has a pretty much a safe bet is any bond that you might have. But risk is just something that, again, it goes right along with investing your money. It means that you could put your money into something, but the risk is that that company may not be there to give you your return. So, for example, IBM used to be a huge company way back when. The stock was very, very valuable. People were paying a lot of money to get their hands on these stocks, and they were paying out a lot of people, IBM was, a lot of profits. However, nowadays their stock is not very attractive, and their stocks and their bonds and all of their certificates that people may not have turned in, they can't really cash them in anymore because that company doesn't have the money to pay out the amount that might be on those stock certificates, and that's the risk that you take by putting your money into the stock market. It may not be there when you go to take it out. There are many different types of risk, things that we've already talked about. So we talked about a little bit of interest rate. You have to remember politics go into a huge thing as far as talking stock market. Any political system that has issues going on with it, it will affect their stock market. And if they're being traded on the open market, especially here in the United States, it would affect those stocks prices that are there as well. We talked about diversification a little bit the last class period. Remember, diversification just means you're putting your eggs in different baskets, so to say. So you don't want to invest all of your money in a food company or a clothing company or a technology company. Because if for some reason that industry should have something majorly go wrong, and you have all your eggs in that basket, all of your stocks are going to tank and go down and lose value. However, if you have different stocks and different baskets, you have some clothing companies, you have some food and technology and airlines and some medical fields. If one of those goes down, the other ones can then balance it out, and it's really not going to hurt your portfolio or your amount of money that you have all that much. Let's talk about investing in the market. So, again, before you decide to invest in stocks, you have to know kind of how to read the stocks in general. So one thing that is huge that you need to know is a stock market table, and it looks something like this. So it is labeled here for you. So you have your ticker symbol. If you remember, the ticker symbol is what's listed on the New York Stock Exchange or any of the other places where stocks are bought and sold. So that's going to be the shorter version for the actual name of the company. So the ticker symbol is just the symbol that's a smaller version of the actual company name. You have the company name, which is the name of the stock, right here. You have the sale 100s, and that is actually the number of shares that traded the last day the stock was traded. And it's given in hundreds because there's so many stocks that are bought and traded every single day that you couldn't really put the full number on there because it would be so big. Then you have the high. So that is the highest price that it sold for the day before. Low is just the opposite. It's the lowest price that it sold before, so you can see the price differentiation. And then finally, you have the last price. So at the very end of the day, when the stock market was closed, it was the very last price that that stock was sold for. And finally, you have the percent change. And this is a big thing that you need to make sure that you're looking at when you are buying and selling stocks. So when you're trying to buy these stocks, the percent change is the amount of change of the stock's closing price